Can the Goldfarb team confirm that we're connected to the call? I only see Goldfarb, Barclays, and EY.
Yeah, then I think there's 23 attendees so far, but they don't have their cameras on, so we we're probably good to go in a minute or so.
Okay. Okay, so thanks everyone for joining. We'll get going in a minute. Okay, why don't we start? Thanks everyone for joining. My name is Ilan Paz. I'm the managing director and CEO of Barclays in Israel, who has the largest global investment banking team on the ground here. And I'm pleased to be joined by two of my senior equity capital markets colleagues, Stefano Conte, who's the managing director and head of Southern European and CEMEA ECM. Nikita Turkin, who's a director in our Middle East, North Africa, and regional ECM coverage team. And the topic of today's conversation is alternatives to US IPOs. And I think that's a concept that people are well aware. Because as we've seen over the years, the bar for a US IPO, whether it's NASDAQ or the New York Stock Exchange, has gone up pretty significantly. And if you look at the median market cap of US IPOs and only 5 years ago, it was around 1.6 billion. Today, it's somewhere around 5.5 billion, which is a significant difference. And the IPO size has gone from 220 to 900, which makes a US IPO out of reach for many, definitely most Israeli companies. So with that, people like shareholders and companies who seek liquidity through the public markets have looked at, different alternatives and other alternatives. And today we'll discuss a couple of those, but especially one which we've seen utilized very successfully by Israeli companies, and we think it's just the beginning. We'll talk a little bit about, again, general alternatives, London Stock Exchange being one alternative, but definitely double click and spend the most of the time of our conversation here on a concept that's called a global IPO on the Tel Aviv Stock Exchange. And those are very different processes than what you would find in a local IPO, to the benefit of the issuer and the shareholders, with large participation from international investors. We'll talk about that. And we'll spend some time with, again, bankers, lawyers, accountants, trying to double click on this possibility and opportunity, which we think is a huge one, and definitely attractive for many, many more Israeli companies than the ones that can access the US market. With that, why don't I turn it to Nikita to take us through the next few pages.
Good morning, afternoon, wherever you are. Thanks all for joining. So as Ilan says, I'm Nikita. I've been doing this for the last 18 years, and I have led all of our Israeli deals and have taken a number of companies public. Sorry, did you hear me? Ah.
Yeah.
Good morning, good afternoon, everybody. Sorry if you didn't hear me. So I'm Nikita, as Ilan says. I've been doing this for 18 years or so, taking companies public, both in Israel, but also in London, as well as New York. So I have a lot of experience and have led every Israeli deal for us over the last 10 or so years. If we flip to page 3, just before we go into particular listing venue, I just want to take a step back and sort of let me start with what we see as the core building blocks of a successful IPO. In our experience, outcomes are much less about execution than the final few weeks of the IPO, but much more about how well companies prepare across a few key areas in advance, sometimes a year or two ahead of any IPO. I think the first is being very deliberate about the type of shareholders and investors you want in your book. The focus really should be on high quality, long only institution, whether that be global or a local. And you want investors that are there with you for the journey afterwards, in the aftermarket, and supporting the story over time, whether for future capital raises or sell downs. The second is getting all stakeholders aligned. It's really important to set expectations early, align those across shareholders, management, advisors, on things like timing, sizing, valuation, the shape of that investor base, and ultimately also where you list. The third is really about structuring. So this is not just about the IPO, but this is about a journey into the capital markets. And so thinking about capital structure, thinking about how do you want your shareholder base to look like, how much capital you want to raise, etc. And then really thinking through to life as a public company. So thinking about things like indexation, how easy is it to monetize or raise future capital, what does the corporate profile of the business need to look like, or you want it to look like. And all of those things need to be designed up front. And if you get all of those 4 pillars early right, then execution becomes much more predictable and successful. So moving on to how should you think about choosing the right listing venue? Look, we think about it in a broad framework. It's not just about one or two things like valuation, although that is an important piece of it. And we really apply 2 lenses. The first is a top-down analysis, looking at where can you get sizing for your particular deal away, thinking about liquidity, thinking about depth of access to investors. And the second really is bottom up. How well does the market fit your company's profile, your sector, and the positioning that you want to leave? And then we cross-reference that with, as I say, valuation that we would achieve, as well as things like research, governance requirements, and the ongoing list. So really, the right venue is not a one-size-fits-all answer. It needs to match what you think the company strategy is, and the type of investor base that ultimately you are targeting. So if we do a little bit of a deep dive into 2 venues that Ilan talked about, the first is the UK. The UK continues to remain probably the deepest pool of, or the UK has the deepest pool of capital. As you can see, it has 5 times the AUM of country dedicated institutional capital. That is funds that are dedicated to investing in UK listed companies. It's just much, much bigger and broader than other European countries. And that scale of institutional capital is what really sets it apart. That typically means that you've got more investors to go to, and you should have a deeper support in the aftermarket, and tends to translate to better liquidity. The second thing is that there have been a number of changes made to the UK over the last few years. It's become much more flexible. You can see some of the things that they have changed. The free float requirements have been reduced from 10%. You can list in US dollars or euros, and we see that companies are taking that route, and we're going to have materially more listings in those currencies over time. Dual class shares structures are permitted. And there's now a single listing category. So this, together with the historical strong sector and research expertise, does make it an attractive choice now for issuers. And clearly, indexation, if you get included in the FTSE indices, can add a material amount of passive demand to your shareholder base. The two we call it downsides to the UK is that there are still relatively few Israeli companies listed in London. These are a selection of a few Sometimes that's more an opportunity than a limitation because it allows you to stand out and differentiate yourself. But it's not as well a trodden path as going into the US. And you do have slightly, I would say, more rigorous at IPO reports you need to produce, such as the Financial Position Prospects Procedures Report, the FPPP, Working Capital and Long Forward Report. Those are diligence reports prepared by the company for the banks that are sponsoring you. They do tend to be a little bit unique to versus other markets and can take a little bit of time, but it is obviously a good place to list. Turning to the TASE is another option. As Ilan says, we think that the TASE has really evolved significantly. Today, we no longer think about TASE as a purely domestic option, but you can do an IPO with international and a distribution and a global outcome. And you can see the number of companies in the last few years have done what we call a global TASE offering. We've seen a meaningful increase in investor demand, including participation from some of the world's largest global investors. Secondly, we'll talk about it in a second, liquidity has improved, market depth, trading activity has improved in recent years, in part due to the change of trading Monday to Friday, or including Fridays as trading. And thirdly, valuation. Outcomes are competitive and increasingly comparable to other markets. And as you can see, we regularly see some of the highest quality investors participate in transactions. So really the narrative around the TASE has shifted. It's now a genuinely credible international route. Well, what has changed over the years? If you flip to the next page, if you look at the data, the change has been very, very meaningful. We've all seen share price performance of the local index be particularly strong in the last couple of years. What's interesting is if you look at the valuations, there is a delta of 1.5 times the European Stock Exchange and almost 3 times the FTSE 100. So valuations are, whilst they move around a lot, and if you go back to a year ago it might have been different, but now they're trading at a premium to European exchanges, and over time had been closing the gap to US levels. The third is, when we look at our own data, we've seen a significant increase in global investor flows and trading into the market. So twice in 2025 what we saw in 2024, and that is a factor of, I said, more liquidity, more time to trade, and we've seen retail participation that has doubled over the last year or so. If we move to the next page, on page 8, and thinking about structuring alternatives, the reality is there are broadly three approaches. The first is a truly international style offering with a global book build, a single stage offering, all to do with price discovery driven by investors. It does come with slightly higher costs than the typical kind of local domestic offering, but the reality in our view is that you get a lot more benefits versus the cost, and it's becoming the de facto route for many companies that we speak to, that would like to continue to be listed on the TASE but would like to access the international shareholder base. On the right hand side, those are the kind of more traditional Israeli offerings. You can see that there is a hybrid version that you can do, but the reality is that most international banks would tell you that, as I say, the costs or the advantages outweigh the cost to do an international style offering. And then lastly, before I hand over to my colleague Stefano, investor engagement on page 9. This is one of the most important drivers of IPO success, and how companies typically now engage with investors ahead of the deal. The process these days is much more front-loaded than it used to be. No longer is it about getting into the roadshow and having a meeting at the end of the deal. We will start very early on, sometimes 6, sometimes 12 months ahead of an IPO, and start to educate investors. We will be very targeted, very thoughtful in the approach, and often it is tailored specifically for your company. As you can see at the bottom of that page, most these are all IPOs that we've done in the last 6 to 12 months. Typically, we'll be seeing, close to 100 investors, well over 100 meetings, and the plan is that we would cover the book from long-only investors alone prior to launch. And in some cases, you may get a cornerstone or an anchor as part of that natural discovery. So whilst our view is not that we should go to everybody, we're still going to be prioritizing quality. You do want a broad outreach, and so a lot of the work is done in the preparation phase, and such a thoughtful cadence of investor engagement early on is what ultimately drives pricing, allocation quality, and aftermarket performance. With that, I'll hand over to my colleague Stefano to take us through the rest.
Perfect. Thank you, Nick. So as we move on to who are the investors that are part of this marketing process and buy these IPOs, this is a snapshot of where the buyers of our EMEA IPOs are located. The picture is clear and unequivocal. 2/3 of the demand on average is in the UK and in the US. So most of the demand, but importantly, is where most of the long-only investors that are setting the price for IPOs are based. So in very simple terms, the battleground for every IPO is won in London and in New York. As we move to page 11, on that early investor engagement that Nikita was talking about, if we can flip to page 11, please. On the early investor engagement that Nikita was referring to before, this used to be an option, it's not an option anymore. It is a standard part of the process in EMEA, but also in the US, increasingly so in the last few years. And the benefits of it are pretty clear. It allows to create very early on relationships between management teams and investors. It allows to have early feedback on the equity story, and importantly, to have the time to fine-tune it during the process. So while the ultimate goal is to gain visibility on the demand and to firm it up after launching an IPO, this is actually the start of a much longer journey. The IPO is a once-in-a-lifetime opportunity for every company to craft piece by piece their public ownership at the beginning of their life as a listed company. And this is the process that allows management teams to actually know for real who is on the other side of the table. Moving to page 12, on the IPO process itself, we see generally companies spend between 1 to 2 years ahead of an IPO process formally starting to set up the organization and generally lead up into the start of an actual process. The IPO process itself is generally a 4 to 6 months process. We have all done IPO processes that have taken quite a lot longer, and we've done IPOs that have taken even shorter than this, at quite a frantic pace. But usually it's a 4 to 6 months process, which then concludes with the public phase of the process after launching the IPO in the public market, leading to pricing and then trading. So as part of this process, there are a number of procedural actions and documentation requirements, which will all be finalized by the company and its advisors. They're all at the bottom. I'm not going to go through them. But the key message is, whilst there will be some differences given by the local exchanges, usually this is a process that de facto is very similar across global offerings, across all exchanges in EMEA. Moving to page 13, this is more from a calendar standpoint. If you think about a traditional calendar year and a company that has a traditional 31st of December financials year end, there are generally 4 windows in a calendar year, and they're defined by the 135 days cutoff post closing of the last quarterly financials, including the prospectus. So these are the windows when the IPO will be in the market. And because it's an IPO that is in the market, and this is a transaction that is done in the market conditions in these windows will be extremely important. It's not possible to forecast months in advance these market conditions in the specific window in a process that lasts for 4 to 6 months. So our advice is to run a process that allows you to be as ready as possible to move around these windows in a nimble and efficient way if it's needed. Moving to the next page. So what are the key pieces of advice to companies and management teams for the IPO process? To me, it really starts at the bottom of the page. CEOs, CFOs, their team, they need to continue running the business during the IPO process, and they need to do that as effectively as they ever did. And the IPO process needs to be designed in a way that allows them to do that. So what that means is when the key time-consuming part of the IPO process are well prepared in advance, it does pay off. So for example, getting a clear view of the equity story early on, getting the right organizational setup internally for the process, setting up in advance any changes to the management structure and board composition. These are all decisions that if they're made fairly early, they will pay off in allowing management to do what they're supposed to do, which is to continue running the business on top of getting the company public. Lastly, we are one of the advisors. So if you can go back on the page, we are one of the advisors supporting companies in IPOs, and it goes without saying that we do think that the right advisors will make a huge difference in the process. Our piece of advice is our advisors that you can really trust and that you're confident that will go the extra mile to deliver success for you. This is a process which lasts for several months. Management team speaks with advisors every single day. So make sure that you know the people, make sure that you trust them, make sure that you like them. On the next page, the first day of trading post IPO is a defining moment in the life of every company. Every listed company will have on their history page on the website the year when they went public. But it's really day one. It's day one of a new life where, as a public company, the public market as a whole becomes a new, very important stakeholder. So investors that were part of the IPO gave each company their initial trust, but the trust needs to be earned every single quarter. And getting a strong reputation with the market is absolutely key for every company. Every manager, every shareholder of a listed company, every party invested in the success of a company, they all want the same thing. They want the share price to grow over time, and they want the share price to reflect the value of the company. And doing the investor relations activities plays a key part in this. Continuing to nurture the relationships with existing investors, giving them the confidence to increase their positions, continuing to scout for new investors who can become shareholders. This is something that every listed company needs to do every single day for their share price to be successful. And lastly, to close off, it wouldn't be a presentation without a second of advertising. I did recommend before to hire advisors that you can trust. It is about the people, but it's also key to work with advisors that have a platform that can deliver the success for you. And we at Barclays believe that we have a unique proposition, given how deeply embedded we are in the equity markets in both the UK and the US, which, as I said before, are absolutely critical for IPOs. And you can see this simply thinking by Barclays being the number one trader of stocks in both London and in New York. And lastly, we're very proud of our long-standing track record with Israeli issuers, having executed the largest number of equity transactions globally for Israeli issuers in the last decade. So I'll close here. Thank you very much for your time this morning, and I'll pass it over to EI for the next section.
Thank you, Ilan, Nikita, and Stefano. I hope everyone hears me and is able to see the screen. So nice to meet everybody. Yoel Lecoq, I'm a strategy and transaction partner based in EY in Tel Aviv. And just want to follow up on some of the trends that we're seeing and get into a little bit more detail in terms of the readiness activities that are necessary for a successful IPO. I think in general, just in terms of kind of echoing what was mentioned by the Barclays team, we're seeing globally a disconnect between mature, strong private companies that have continued to grow, and this disconnect between receiving access to the public markets, and you could see here by the number of unicorns globally, and the relatively small number of IPOs. In Israel, we're seeing the same trend. We're seeing a lot of robust companies that have been established over the last decade, and a lot of them are unicorns, and not always. Some of them are very healthy, robust companies, and they just haven't been able to seek liquidity for various reasons, and some of them are mature. And given the investors' need for liquidity, I think this is becoming alternatives that need to be considered apart from the traditional U.S. IPO. Another interesting anecdote is around what we call the silent unicorns. So here is just a clip where we see 38 companies which are unicorn status that haven't raised capital in the past several years. Some of these are due to capital raises several years ago at excessively high valuations, but others just haven't. Some have not grown into the valuations that they had previously raised, but others would have considered a typical IPO process, but haven't considered options that are alternate to the U.S. public markets. I think globally what we're seeing at EY, and I'm sure that others are seeing this as well, is that it's not necessarily just a one-time shift. I think generally we're seeing that companies are staying, larger companies are staying private longer, whereas in the past they had seek to go to the public markets earlier. And as was previously said, the bar to issuing is becoming higher and higher. So far in what we are seeing is that it's been a bit of a slow start to the year, both in the number of global issuance and IPOs and the proceeds, and it hasn't yet. We're behind where we've seen activity in the last couple of years. So it's a slow start to the year, and I think in general the sentiment is that it'll remain a bit slower than past years. And just on the same note as obviously some of the names here are the companies that are seeking offering and just showing that the bar is excessively high. Specifically, SpaceX here is already valued at 3 times the number that's over here. So a lot of our very robust Israeli companies are significantly smaller than the companies that are coming here. All of this is how do we consider the options that were mentioned apart from NASDAQ, which has been the traditional route for a lot of our clients. I think that offering in Tel Aviv or in London should be considered. It was briefly mentioned about some of the requirements, but we'll go into that a little bit in more detail. In general, I think the success of an IPO starts a lot of times significantly before the actual offering. So the readiness activity is really an important activity. I think we're all familiar with the stringency and requirements that are necessary on NASDAQ, but oftentimes a lot of our local companies operate with fairly lean finance functions. So from the finance accounting functions, as they grow, they're often a pretty lean environment, and that needs to be built up ahead of any IPO. Whether we're talking about offering in Israel or in the UK, and that's not something that tends to be done overnight. There's work and processes that need to be put in place in order to meet the reporting requirements. Oftentimes, here we show the accounting framework. So I think a lot of our companies are from the outset reporting under either US GAAP or IFRS, and depending on where they list, sometimes they need to consider an accounting framework change. Okay, if they're reporting under a local GAAP and need to consider a change to IFRS, obviously that process takes time and needs to be considered in advance. There are certain cases where you can offer under or remained in the global offering under US GAAP. Specifically with regards to the London offering, and it was mentioned briefly, there are specific reporting accountant deliverables that are necessary at the initial issuance. and I'll just dive into those quickly. In London, part of the IPO process is there's a role called the reporting accountant, which obviously EY functions as a reporting accountant, and there are several reports that need to be produced in advance of the offering. And one of those is called the long form, which is similar to a historical diligence process, looking at the prior 3 years. The second one is what we call the working capital, and is that essentially a cash flow stress testing exercise, looking at a minimum of 12 months post the IPO, but it often extends to 24 months, and that is essentially to ensure that the company has enough cash to maintain post IPO. And the third one, and extremely important one, is the FPPP, which is essentially a controls report. And what's important there is that the companies need to show that they have the controls in place prior to the IPO. So coming back to the point where companies operate with a lean operation, a lot of times they need to implement specific controls. And again, these are not things that are done overnight, and processes need to be put in place in advance. So I think, as was mentioned, any successful IPO often starts with the readiness activities and thinking about building out the functions, not building out the team, building out the ability to report, whether it be in Israel quarterly and annual statements, or in the UK it's interim, half year, or year-end reports. So building out that function and ensuring that these quality financials can be produced in the right amount of time, and with reliability, is something that is not done overnight, and needs to be considered in advance. And then some of the functions that didn't necessarily exist need to be developed and put in place prior to the offering. So we're as well seeing that Israeli companies, well, it was mentioned that there was a few companies. We do see the UK still being, there's few Israeli companies, but there are definitely more companies that are considering that. And then this global offering we also see as a very attractive route, and basically both of those to consider the alternatives to what was traditionally just seeking the US offering. Thank you, and I'll pass it to the Goldfarb team.
Okay, hi, I'm Eyal Shenhav from Goldfarb. I'm the chairman of Goldfarb, Gross Seligman. I'm also heading the high-tech practice. With me are two partners, senior partners, Aaron Lampert, who's our expert on international IPOs, and Tamar Luz, who's our expert on Israeli IPOs. And we'll try to handle, the questions of going public. I'll try to address it from the venture capital side or private equity side. And then Aaron and Tamar will obviously talk about some of the legal issues you have to think about when you go public. So let's start. I think the main question for venture capital funds and private equity funds is how to handle the shares once the company became public. It's very often that a private equity fund or a venture capital fund will hold a significant position. The company could be 10, 15, 20, even 25%. In most partnership agreements, there's a very clear rule that LPs, limited partners, will only get cash or what you call marketable securities, securities which can be freely sold on the market, not subject to lockup and not subject to restrictions. And historically, when companies went public, the general practice of funds was to make a distribution in kind to the limited partners. And each limited partner would get securities and would be able to sell them at the market whenever they want and based on their judgment of where the share price is going. In recent years, we see a different trend. We see that The distribution in kind was not very successful, put a lot of pressure on the stock. 15% of the shares being distributed to limited partners puts a lot of pressure. Everybody goes out and tries to sell their shares. And the current practice actually is to keep the shares within the fund post-IPO, sometimes for several years. And it allows two things. Number one, it allows an orderly disposition of the shares without impacting the share price. And it also hopefully will allow the LPs to benefit from the appreciation of the shares post-IPO. I think one of the most significant examples of this trend is Sequoia Capital, which is one of the leading venture capital funds of the world, a longstanding client of our firm. And they understood that actually holding the shares post-IPO may create a lot of value to the limited partners, and actually move to a structure which is evergreen fund as compared to most funds which are based on a 10-year, 12-year term. And if you move on, move the slides, you'll see what happened in NVIDIA. Aaron, can you move the slides? Basically, if you look at this NVIDIA example, which is obviously an extreme example, someone who bought shares of NVIDIA when it went public has made a multiple of 800 times. And it just shows you that a lot of the value, or even I would say most of the value of companies may be created way post-IPO, and holding up the position for a long time provides a lot of value. The second question is whether the fund should continue to stay on the board of the company post-IPO. Obviously, the fund was an active board member before the company became public. And once the company goes public, there's a decision to be made whether you stay on the board or you decide to resign. Obviously, the benefit or the best thing that can happen when you stand on the board is you continue to support the company, growth and strategy. You're continuing to work closely with the management and help them with the guidance they need post-IPO. But the downside, obviously, for the fund to consider is, first of all, the increased liability of being a director on a public company, the risk of shareholder lawsuits if the company doesn't perform well or doesn't report certain significant events. And maybe just as important, once there is a director from the fund sitting on the board, this director has inside information, and it creates a lot of restrictions on selling the shares. And each fund has to make a decision whether or not to stay on the board, and there's various strategies here. Moving on, the question is, okay, we hold the shares, we didn't make a distribution in kind. What's the strategy to sell the shares? And the three main strategies. One is to do a secondary offering. The company would do a prospectus, would register the shares held by the funds, and there would be a secondary sale as part of a prospectus. That's one strategy. The second strategy is obviously to sell the shares to institutional investors, mutual fund, pension funds, hedge funds. And obviously the benefit of that is that it's a much quicker transaction. There's no need for a prospectus. You don't need the company to initiate a prospectus here. But obviously these institutional investors often request a discount to the market. Depending on the liquidity of the shares, it can be 5%, 10%, 15%, but it allows a quick execution in selling the shares. And the third strategy is obviously a long-term strategy, which is to dribble shares in the market. If a fund holds 15% of the company, obviously selling 15% takes a long time, but that's obviously a strategy. And each of these alternatives obviously is quite complicated, depends a lot on a lot of factors, such as the liquidity in the market, the average trading volume, what is the percentage ownership in the company, and the remaining term of the fund. If the fund has maybe 1 year to go, it's one issue. If it has 5 years to go, it's a different maybe alternative. So all of these issues have to be taken into account. What we've seen recently, obviously, it was a very big trend in the US, but it's also here in Israel, and we were involved in some of these transactions, something called a GP-led secondary transaction, which means that if a fund gets to the end of its term, instead of liquidating the fund, there's a transaction which a new fund is formed by the same GP. A new investor comes in, and basically he liquidates, that investor liquidates the old investors, and they get liquidity, but the fund continues to hold the same securities. Some investors decide to continue and roll over the position into the new liquidity fund. And that allows the new fund, the continuity fund, to continue to hold the shares for another period of, say, 5-10 years. So it's a very interesting strategy to explore. Moving on. In case the fund decides to make a distribution in kind to the investors and give the shares, not cash, it creates a lot of governance issues. For example, one of the main issues is what is the valuation of the shares? Do we do it by the date of the distribution? Do we do it by 30-day average? Do we do it by the weighted average volume on the market? There's a lot of alternatives, and often the fund documents dictate, but sometimes they're not as specific, and the valuations can vary significantly based on the model we choose. Another question when we do a distribution in kind is how to allocate the shares between the limited partners and the general partner. Obviously, if the fund has already returned the whole fund, it's the GP is in the carry, and they get 20% or whatever the carry rate is of the shares distributed. But in many cases, actually, the company which went public is the home run of the fund, and the GP is not in the carry. And then there's a lot of questions. The valuation becomes very, very significant. It can change the allocation to the general partner. Another thing, which is obviously something to think about, is the GP holding the shares with the hope that they will increase in value so it gets into the carry. Often we advise GPs when they hold shares for significant periods to get approvals from the limited partners that they are agreed to continue to hold the shares and wait for future appreciation, and not view this holding as some self-dealing or benefiting the general partner. So a lot of issues. Try to cover them quickly, and I'm going to move over and give Aaron and Tamar to talk about the securities law issues relating to going public.
So going to our angle from the Israeli lawyer's perspective, just as a general background, the ISA is a very professional, very accessible, and very encouraging towards public offerings, and works transparently with issuers. And generally, it is a good experience if you come prepared to the process. It involves roadshows and testing the waters, similar to what is common in the US. But the timeline for the process is generally very tight, and companies usually go out on the same financials as the initial filing. And as a result, the entire process from initial drafting of the prospectus, the beginning of the work, until publication of the final prospectus is usually 5 months. I don't want to go into too much detail here, but I will say that the companies must provide advance notice to the ISA 1 month in advance of the initial filing of the prospectus, which is a bit uncommon if we compare to the US.
So an interesting development is that you can now do a prospectus for a Tel Aviv Exchange offering, either in Hebrew or in English. And the same is true for ongoing reporting. Tamar and I are now working on an offering by a global issuer. They are raising money in a global offering in Tel Aviv, and the prospectus is being prepared in English, which is obviously a big advantage for the management of the company, but also for investors outside of Israel. One thing I would note is that the prospectus requirements in Israel are highly technical. The prospectus is not the sort of marketing document that you may have seen in US offerings over the last few years. That's not to say that the ISA would not permit it. but it's certainly not common if it exists at all. And finally, in contrast to the past, when offerings in Israel were only by means of a Dutch auction, for quite a few years now, the company can choose whether the offering is by book building and underwriter allocations or the traditional Dutch auction.
Right, and the TASE mandates that pre-IPO holders will be locked up, and there's various periods for interested parties as opposed to non-interested parties. Next slide. So going to the point of encouraging companies to go public, both ISA and I think the TASE has a real impact here. They provide reliefs for small companies, for high-tech companies, and for all companies during the first 5 years from the issuance. And these include both reliefs from corporate governance requirements and reporting requirements, and companies do take advantage of these reliefs.
There is a dual listing regulation which allows companies traded primarily on overseas stock exchanges to continue reporting in accordance with the reporting requirements, the regimes of those stock exchanges, and simply filing their foreign reports under a wrapper with the Tel Aviv Stock Exchange. That is an advantage because the company can do a global offering in Tel Aviv, and if after some period of time they want to move to the NASDAQ, they can do so, and with shareholder approval, switch to the US reporting standards and not have to deal with two sets of reporting requirements. What I would say is that in contrast to the US, the Israeli reporting requirements are very fast. Contrary to an 8K, for example, in the US, where you generally have 4 business days to file, in Israel, the reports may need to be filed within a matter of hours. So it's very important that a company going public in Tel Aviv be set up to comply with those timelines and the reporting requirements. The other thing is that in Israel, unlike some foreign exchanges, the reporting is triggered at quite an early stage. So that unless a company is able to find an exemption, and there are generally exemptions that do allow deferral of reporting, but the basic rule is that even if you're in advanced negotiations, or even if you've signed a non-binding letter of intent, that would normally be something you need to disclose. There are exceptions in cases where that would undermine the deal, but it's important to be aware of the general rule. And finally, in this regard, there is an issue for US companies that want to do an offering in the US. So if you have a structure which is more and more common, where the parent company is a US company, if you want to do an offering in Israel, you may need to do a US prospectus as well, which is obviously burdensome and triggers all sorts of reporting requirements.
Alan, if I can just add to the 2 points about the reporting deadline, the ISA has elected a very famous professor to head a committee, and this committee is working towards changing the deadlines for reporting to make them similar to what is common in the US. And there was a very big noise about this, and hopefully they will do this by the end of the year, but time will tell.
Thank you, Tamar. And finally, the London Stock Exchange, as has been discussed, is obviously a very attractive option. We're talking about the main market here, not about AIM. And as was noted by Nikita, London has become increasingly flexible. There is a new regulatory regime which simplifies matters, and forward-looking information is now something that you can use in London much more readily than you could before. So that could be very attractive. And because of relief available under Israeli securities regulations, Israeli companies traded overseas, whether it's in the US or on the London Stock Exchange, can elect to follow certain corporate governance procedures in those markets rather than comply with the Israeli rules, and the London Stock Exchange is eligible for that. Thank you very much.
Thank you, Aaron and Tamar, and to all of our speakers. So we will address some questions from the chat now. We received some questions, but please feel free to post in chat if you have any more. So first question I'll address to Nikita from the Barclays team. What are the thresholds and KPIs to IPO in London and other venues?
Thanks. It's a great question. Look, there isn't a single hard threshold. It's really a combination of factors that we look at. Obviously, the first is size and therefore liquidity. I think irrespective of whether you're doing London or a global offering on the TASE, it has to be large enough for international investors to participate. So what we really mean by that is starting from $150, $200 million plus type transaction is really where we start to see global engagement. And if you think about the market cap, that's probably, that would be kind of 25% of a market cap. So you're talking about a market cap of kind of $600-800 million onwards. And this is really more about ensuring sufficient free float and liquidity and giving investors the confidence to be able to build positions. And then it's about building or having a clear and credible growth trajectory and a story that either has good growth and a path to scalability, or one that is already mature and has profitability. If you can, and the likes, and being able to pay a dividend. If you can have both, then I think you start to be in a very interesting space for investors. And what investors are going to be most focused on is visibility around the KPIs that you have. So it's about predictability, it's about resilience through the cycle, clean financials, strong reporting, a strong management team that's experienced, and the ability to kind of give a view on what the forward outlook is going to look like. Then the couple other things is governance. Any company that wants to target international investors, it will be about how strong is the corporate governance to be able to protect minority rights. So having the right board structure, reporting standards, all to be institutional grade, and that does take time to put into place. And ultimately, the question that people ask is, does this company fit into my portfolio? Is it interesting enough? Is it attractive enough? And will I be protected as a minority investor? So it's not a single strict threshold. It's about that combination of investability, liquidity, and visibility if you want to access global markets.
Thank you, Nikita. Second question from the audience, which I'll address to Stefano from the Barclays team. How should Israeli companies think about the typical discount required in a global offering on TASE, particularly given that international investor may be less familiar with company versus local investors?
Yeah, look, it's a great question. That I will start from the second part of it and slightly apply different lens to it, which is that the fact that international investors are less familiar with a company that goes public is something that happens everywhere, right? So obviously, if you are SpaceX going public reportedly soon, everyone in the world knows you. For a lot of companies that are a lot smaller, often when they meet investors for the first time, investors don't really know much about the company. And the benefit of how the IPO process has evolved in recent years, which I went through in our presentation earlier, is that now, instead of having 2 weeks to educate the market post-launching an IPO, as it used to be the case before, you have months to meet investors, very often 3 or 4 times, and to create a relationship with investors that allows the company to fully educate investors on the business. You need to think about investors getting to the point of, when an IPO is launched, having spent several hours on the investment case, having access to multiple versions of marketing materials and information on the company. So there is time in every IPO process to fully educate investors on the investment case. And if you then by that argument, then the question is there in any given market globally a structural incremental discount that we see investors demanding because of a specific local exchange? Now, it's fair to say that we probably don't have that many data points on global offerings on the TASE yet to articulate that. but it doesn't strike me as the case of an exchange where you would have a structural discount. The truth is that the exchange is now sizable, is getting liquidity. A very significant number of international investors are operating on the exchange. A lot of companies have been very successful. The liquidity is there. So in the end, it comes down to, for the IPO itself, are investors going to demand some level of discount? We call it IPO discount. Naturally, every investor will normally ask for some discount at the point of IPO. It's just very normal and understandable that an investor will want to generate some level of extra return at the beginning because they are providing capital at a point in time where a stock is not trading and it's day zero of the life as a public company. But that IPO discount, we can define it in several different ways, but it should be the incremental return that a stock provides compared to their peers in the first few weeks post IPO, and that usually tends to be something that is in the ballpark of 15%. That is really not changing. What I think has been the disconnection in recent years is what is the discount, the IPO discount compared to the discount versus a certain peer, right? There should be a clear view of what should be the real valuation of a company once it goes public compared to a certain peer. The IPO discount is something that is applied to the valuation, not necessarily to the peer, because not a company does not necessarily have to trade at the same level of a certain peer. It should trade on par, it should trade at a discount, or it should trade above. That depends on the specific company.
Yeah, can I just add one comment? I think that if a company, an Israeli company, let's say $1 billion market cap, goes public in the US, it's probably not going to attract as much attention from analysts. While if it would go public on Tel Aviv Stock Exchange, it would probably attract much more attention and would be followed more closely by the Israeli institutionals and may create a higher valuation or definitely not a discount. I think another potential issue is that because it will be trading in shekels and not in US dollars, there'll be maybe more appetite because a lot of investors are now moving away from dollar into shekels. So obviously, the discount is a big issue, but it's more complicated. It depends a lot of whether you get into the index, don't get into the index, what kind of institutional coverage you can get, the monetary trading in shekel, dollar, pounds. And I'm not sure there is a discount to a company between Israel, US, and UK markets.
Yeah, can I just have one point? I also think that it's important to contextualize. We IPOs are all different, and the reasons for IPOs are all different, and the ownership structure of IPOs are all different. I think as you think about the value in the IPO itself, it very much depends on what is the ownership structure and the future plans for a company, right? So if a company is being listed with a 30% of their shareholding that is put in the market, and that is a single founder, family-owned business, and there's not going to be supply of stock in the future, then the value of the 30% really matters. But if a company lists with a small free float and there's a wide shareholder base that is going to look to monetize over a period of 2 to 3 years, then the objective of the group should be for the stock to be gaining as much as possible over the next 2 years rather than the value at IPO. So the value at IPO is simply the starting point of that process.
Thank you both. And last question, which I'll address to Nikita from the Barclays team. Isn't it the fundamental problem with the Tel Aviv Stock Exchange is that US institutions cannot open up local accounts with local banks?
Yeah, I'd say it used to be a constraint. I would say now, and it's a fair question. I think now that's largely mitigated in practice. It's not, access is not really as restricted as it's perceived. In practice, most global institutional investors that we speak to can and do access the TASE, either directly or via established custody and brokerage agreements. And look, I think the infrastructure has improved over the last few years, but there are also ways that we can structure it to enable institutional international investors to participate, such as writing swaps. I think what's really important is that when I look at the deals that we as Barclays have led, we're already seeing meaningful participation from global investors. We often have international investors that cover the book of demand completely just by themselves without the need for local investors. That isn't to say that we don't then add the local investors to add, a sense of competitiveness, and also the way we allocate books are very different from a demand point of view. But I do want to leave people with the view that this is reflected in reality and the actual deal box that we've looked at. The other thing that I would say is that when we do a global TASE offering, the transaction is structured such that we facilitate international participation. We're not expecting investors to figure it out themselves. We've built it into the execution. And we will work with them and do work with them both on the ECM teams and our back office teams to structure it such that they can participate. So, I'd say that it's not really longer a fundamental constraint. The key determinant is not access, but how you think about managing and structuring the process that you bring international investors into it.
Thank you, Nikita. So we're running a bit out of time, and I will now hand over to Ilan from the Barclays team to give us the close remarks.
Yeah, sure. So thanks, Steve. So hopefully we piqued people's attention, and look, this is an increasing dialogue we're having with companies as oldies like me a lot of times say, oh, the local stock exchange is for Israelis. The companies that really want to go global, they should list outside of Israel. And that used to be the case until 5 years ago. Definitely not the case nowadays. And I think the stock market has done a lot in order to enable that, both on the trading days, but also in ability. They run these offerings, and now they cater to a very global investor base, which is not shy to invest directly in companies in the local stock exchange. So, value, and again, as we said here, valuation gap has closed, if not disappeared. So a lot of the counter arguments of why Israeli companies should not do them have gone by the wayside. So what we hope is that people, don't rely on data which is decades old, but really look at what's been happening in the last few years and make a judgment call based on that. So with that, I'll end the call. And obviously, ourselves, Barclays, Ernst & Young, Goldfarb are all happy to have specific conversations with companies and investors on this topic. So feel free to reach out to us if you want to discuss any of these topics further. Thank you very much for joining today.
Thank you.